Hello, future millionaires, and welcome back to the Get Rich Slow podcast. I'm your co-host, Adrian Schermer, joined here by the famous Robert Delavan.
I don't know about famous, but good morning anyway.
We'll work our way up there. Today, we're going to continue a little sort of mini series we're doing about really just our period of expertise here, the home lending process. In a previous episode, we started this off by talking about pre-approval, how important it is to just dive into that process as early as possible. Pre-approval, as I had mentioned, is really, I'd say it's half education, at least the way I do it. So if you want to learn about owning a home, applying to own a home, even if you're not air quotes ready, is a great way to get into it because that application is more of a consultative process than a, like a credit card where they go, nope, right. Yes, here's our offer, $300 secured, take it or leave it, bye. Right. You got 30 days to it. Pre-approvals do expire, don't get me wrong, but especially in lending, generally, we tend to work with people for a really long period of time in certain situations. Sometimes it's instant. Sometimes I've worked with people for years. So get in there and try it. But let's move to the next step.
Right. So
I got the pre-approval. Here you go, Rob. This
Great.
person's pre-approved for this payment. Send me some properties.
So we do. So let's say we do our thing right on the real estate side, and we are now in contract. All right, hooray!
Sweet. You made your offer. You got it accepted. Masterfully negotiated.
There you go. All of those things. Now we're in contract, and inspection period started today because we got into contract yesterday at day 0. Yep. So what's next? Now we're going to negotiate and do all of our things, and that's different episodes. But from a lending standpoint, okay, you're in contract. The contract says 3 business days, you have to have an application, even though you've already done a quasi application through the pre-approval process. You have to apply for the loan that you're going to purchase for that house. And when I say that house is, now we know the price, now we know the earnest money, now we know the down payment. We're going to continue to negotiate through inspections, but now we know the terms of the loan, at least the basic terms of the loan. So, okay, let's start over again. First step, go.
First step. So when you guys get the contract, of course, you send it to me and you send it to title, and simultaneously a number of processes begin. And you mentioned it as an aside, an inspection is not typically required by anyone, but we would highly, highly recommend it. We've talked about this so much. I'm just going to say your opinion for you, Rob. Because
yes, thank you.
We're firm believers. I believe you should get an inspection if you buy even a car, let alone, a 6-figure piece of asset, a property, especially as much as you can pay for a home. You should definitely spend a few $100 making sure that an expert looks it over. So that'll get ordered on my side in the lending department. A bunch of extremely talented people who I rely on are going to dial in. So we had an application where it was a lot of hypotheticals and what ifs. We're estimating what taxes and insurance are going to be based on averages. Maybe we're dialing it into a specific property to run numbers, but now we have a contract in front of us. The figures are very certain, and we're going to put that all together and send you what really makes it a triggered, as we say, application. Just like you're saying, we got that 3-day window from receiving contract to dial everything in and then send you what is a very large packet of disclosures. It's over 100 pages, and it can get very confusing and overwhelming when that hits your door. Most of this stuff gets signed electronically. And the document package breaks down into a few different subcategories. A lot of it is boilerplate, cover your butt.
It's okay. We're PG-13 today. Cover your ass.
It's a lot of CYA. It's a lot of letting you know rights that if we were as a lender to violate, we'd get shut down so quickly. For example, one of the pieces of paper lets you know as a consumer that it's your right to receive a copy of your appraisal. I don't see any reason why a lender wouldn't provide this to you, but we have to have it in there because someone screwed up in the past, and now this is a system. Same thing about your rights. You have a right to choose your own insurance company. honestly, a lot of people put this off. Day one, you should be calling up insurance. It's going to have an impact on your payment. I am in this industry and I have a rough estimate that I use. I usually use 0.25% of the purchase price as a yearly premium. But then in my own house, I'll mention this all the time, the emergency room is right there. So my premium ended up being I'm way less than that. I mean,
like an eighth,
a fifth of that. Yeah.
Something like that. You're right.
So, you want to get it dialed in because it's going to impact your monthly payment and your cash flow, no matter what kind of loan you're doing, even if you're paying insurance and taxes out of pocket. Obviously, it's an expense that you need to factor for. So we get everything dialed in. And then I think the most important part of that disclosure package, and if you breeze through all of the, I mean, there's so many words in there. It's like an Apple terms contract times 10,
Oh, yeah. That's crazy.
There's a lot of stuff. And I think that it's one of the faults in the system is that it's so much data that people kind of gloss over about page 5 and then just burn through it, click, 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 especially with e-sign. It's so easy. Slow down for the loan estimate. That is, at this point, this is the rough draft of your loan. There's still plenty of room to move around and change the terms in there. What you're seeing there is not final version necessarily, but it's going to quote you for fees. And there's a tolerance. Those can only change by a certain amount, a lot of the title fees and stuff. And then it's also going to start with a rate, and it's going to build out a payment based on that rate, but it's not necessarily going to show what the charge or credit is for that rate. And that gets into kind of structuring your loan, which may or may not be another episode that we can kind of really peel into all of these, layers of options. It's a matrix. Sometimes it's difficult to even communicate to clients just how many options there are out there. But that's our job as a loan officer, is to simplify that hopefully into 3 or 4 more logical choices. There's some that are going to be not really make any sense. And then there's some that are going to be a matter of choice. And the biggest one, just for kind of the broad view on it, is that you can pay more money when you do a real estate transaction. Most of the time, you can pay more money to buy a lower interest rate, or you can pay less money or even get a credit towards your closing costs to get a higher interest rate. And that strategy really just depends on how long you're going to own the home. If this is a 5-year deal for you, you probably don't want to spend a lot of money buying a lower rate because you may not get that money back in monthly payment savings. If this is the forever home, and I've had this conversation with a lot of people who are moving, from their 4-bedroom house they raised their kids in to that single family, or single floor rather, 1 or 2 bedroom little retirement house. Payment is everything because it's all about cash flow. So we want to try to drive that rate down, and we want to kind of secure the most stable and low priced monthly payment. So your mileage may vary. Obviously, like a lot of things we talk about, situationally, we're going to make decisions. But bear that in mind, especially at the beginning there. A lot of people sometimes think this is the time to go back out shopping for a lender or for rate. You are putting yourself back against the wall when you do that, because 30 days sounds like a lot of time to close. We are typical closing. We usually book about 30 days. There's a lot that has to happen in that time though. So if you're going to shop, you better do it really early, and you better hit the ground running if you switch the company that you're with. Usually you can't at that point without really causing some chaos, but legally you do have a right to still switch lenders at that point. And it's a good thing, because if the person that you were talking to turns out to be lying and they want to charge you an exorbitantly high rate or a high cost for a given rate, you still have the ability to sidestep. But
it really needs to be done in those first 2-3 days, which is doable. The caution I would have, and this goes back to the whole concept of, our project here, right? Is you want to have relationships. Well, if you're out shopping and you have 3 days to do it, hey, I got 72 hours to go shopping. Well, are you going to be able to build relationships with anybody else other than, shyster salespeople in 3 days? You might, there's some good ones out there, don't get me wrong, but you have to be able to build a relationship in 3 days. Well, when's the last time you built a relationship, in talking to somebody for 10 minutes? Maybe 3 times if you had a chance.
And at that point, you're the sale. So it's this is one of the hardest things about it too, is there are a lot of empty promises that are offered up front. When I did my house, I decided that I would play the, completely ignorant consumer who has no idea what's going on. I jumped on all the big sites. I put my name and my information in, and I just let these people absolutely bomb me. And really, the strategies that were used kind of blew my mind. I mean, I have an ethical standard that I set for myself, and I'm hard on myself with those rule sets. To listen to the things that people were telling me, to be lied to, and to be almost pseudo manipulated, or attempted to be manipulated, was, at least for me, a fascinating process. But it really woke me up to the idea that there is a lot of misinformation out there, unfortunately. And someone will treat you like you're very, very important right up until they have your business. And then some of those people will just walk away, because then you're not going to make them more money. You're already in, you're stuck. We already ordered this, that, and the other thing. You're not going to go away. So I'm going to go move on to the new business that I can generate. So, yeah, having a relationship, and especially ideally, if your realtor and your lender can have, if they have a back end relationship, that is really nice, because it means they can communicate in your best interests as our mutual client. And we have conversations like that all the time, right, Rob?
Right. And the key there is there's these relationships because there's a higher level of accountability between you and I, broker, real estate broker, and lending broker or mortgage broker, versus somebody.
If I drop the ball on this client, I could lose you forever.
Right. Exactly. And we're going to share, 50 clients a year or more.
Yeah.
And we have to be accountable for the next one, the next one, and the next one, versus the client out there that's listening, the buyer, or in this case the buyer, usually, because it's a lender involved, but they have to, okay, they're going to be a client again in 5 years,
right?
Yeah, oftentimes it's sooner than that, but the average 5 to 7 years is how often people buy and sell homes.
Yeah.
So there just isn't that ability to get as deep as often as we can. So you're relying on the strength of our relationship. So they've settled on the lender.
Yep.
Obviously, your
we can step back to that day one
is good.
Yep.
And
usually we're going to lock the interest rate within that initial period there as well. So just to kind of 10,000 foot view of this concept, when we lock, we're effectively hedging the money that you're going to be using to borrow. So if on that particular day, 3.25% is a rate that has no cost, no credit, it's called the par rate at that point. When we lock you into that rate, we're locking you into all the rates that were available that day. That means that even if you change your mind a few days later and say, hey, I remember you told me I could get down to 3% for 1% of the loan amount, this is just an example. It's going to be different every day. It's a moving market. This gap, I'm not saying that you can get 0.25% lower for a point. Could be that one day. It could be 2 points the next day. It could just depend on which rate you're going between. But there's a whole grid out there. And you'd have the ability to move between those options and make other choices, like whether or not you want to have monthly mortgage insurance, or you want to pay the larger single premium cost to do one and done, a big lump sum at closing, and then not have the monthly mortgage insurance be part of your payment, which you can usually do with like a conventional loan, but not with, for example, an FHA loan, typically. A lot of sub options here. And there's unique loan products that will always sort of fill the void depending on people's pain points. But knowing and understanding how this stuff works at a higher level can help you avoid. I got to say, one of the pitfalls I see is that it is important to have goals in mind, but I have watched people pay more because they didn't, for example, understand mortgage insurance. So they want a loan that doesn't have it. So they'll get one that has a much higher interest rate. Well, the rate is there for 30 years. The mortgage insurance is there for 5, maybe.
Yeah.
If your house has slow appreciation, maybe less. We used an example just a couple episodes ago about, in 3 years from 5% down, having 20% equity. So that's another episode, though. We talked about mortgage insurance in another episode, so I'm not going to go too down that rabbit hole. But in this initial period, there's a lot to be done. So you're going to be doing your inspection with your realtor, in my opinion, if you're smart. You're going to call at least 2 insurance companies right out of the bat. Same thing here. If you got someone with a relationship, that's great. We want people who are going to react, who are going to get the documents that are needed for the lender quickly, and be able to get you qualified for the insurance rate that they're quoting you initially. But I do recommend going to a few different companies. I say the same for any type of insurance, really. Auto insurance is also the same way. Most people, when they're younger, they'll end up with Progressive or Geico. But then as you get older, companies like AmFam and Farmers and, a bunch of other companies, they cross paths. The premiums cross paths, and the reason is because those companies are targeting specific demographics. Progressive and Geico, their bread and butter is young drivers, so they are cheaper for young drivers. You go quote AmFam. I mean, my experience anyway, it's something like 4 or 5 times as much. They have to quote something. So they quote something ridiculous. And if you happen to book it, then that offsets the risk for them. But most have their own niche in the market, and homeowners insurance is no different. So some companies may be exorbitantly high because a property is risky. Maybe it's got like a pool, let's say, where another company that might be what they do day to day. So they are able to have a lower risk threshold. So
right. And
grab your quotes.
I'll mention it's important to take care of these types of things like insurance ahead of time.
Yeah.
In the sense that we're doing this we're not doing this 4 days before close and asking an insurance agent to put together a policy. We're doing this like a day after contract. And yes, there's a risk that everybody's going to do all this work and the contract isn't going to fulfill or go through or whatever. But at the end of the day, we'd rather do the work up front and call that collateral damage as time wasted than get 3 days before closing and say, oh shit, we don't have an insurance policy or binder, as we call it in the industry. We don't have an insurance policy in place. Therefore, we can't finish the loan because the lender, of course, can't do a loan on a property.
Real bummer of a way
insurance.
To lose days off closing. Yeah.
Exactly.
But I've seen it dozens and dozens of times before. It takes 2 to 3 weeks to get that actual quote. We had one recently where the insurance agent wasn't able to insure the property, which is extraordinarily rare, but banking on that not happening isn't worth the risk. Just want to take care of this stuff as quickly as you can up front. So when or at least when your loan officer or their assistant reaches out to you and that initial disclosure package comes out, they're also going to be asking for updated documents. You pre-qualified with pay stubs that are probably already too old. So you want to, if you really wanted to jump ahead and be a superstar, when you got that contract coming in, go get those pay stubs that cover the most recent 30 days. Make sure that, if you sent me June and July, but it's already September, send me your August bank statement because I need the 2 most recent when we enter underwriting. And we really want to hit, the ideal is when we hit underwriting within that first week. That's the sweet spot for me. I love that because then we got all our, underwriting is going to review your loan. It's always going to be a conditional approval because they're still going to need the appraisal. They're still going to need other documents, stuff from title, stuff from the insurance company as they're building that binder for you. But by getting this all started in that day one, regardless of what lending company you're working with, you will set yourself on the right path to, at the very least, uncover problems early. So you still have 2 weeks to solve them instead of being back up against the wall if something pops up. Because I've been there with clients when they didn't provide documents, when something was harder to get. And then it's just frustrating because it's hard to set the time scale after that. Much better to be done early.
So you've, the other thing is right at that same time. So we've done the application. You've updated all of your documents and application disclosures.
You sent your earnest money into title.
Yes, everything's earnest money with title.
It's going to happen within the first 3 days, typically.
Right. And talk to your insurance agent to get the new insurance policy. And then you're ordering the appraisal.
Yes.
And
appraisal
this is
super important.
An interesting piece. We will do an entire episode on appraisals, whether they come in at value or above value or below value and what all that means.
Yeah.
But you're ordering the appraisal. Now, here's the thing. You're typically paying for that appraisal up front. The lender's going to ask for a credit card.
Most lenders are going to ask for a credit card. And then they may charge, or in a lot of cases, the company will put just a hold on there. Right. And then if we get to closing, that becomes or continues to be part of the closing costs, whether that's paid with a seller credit or paid as part of your money out of pocket. Remember, closing costs are separate from down payments. They got to be paid by someone. You can work a seller credit into your contract so that the seller will pay for some or all of it, or you can expect it to be a big chunk of your money. And because we're a national podcast here, I don't want to necessarily quote figures. I know that for me in the Portland metro area and in Washington, $4,500 plus a year's worth of taxes would generally give you what closing costs were going to be.
Right.
as a really rough estimate, just to kind of like if you're on the fly looking at 30 properties and you want to just get rough numbers. But there's a huge variance there. And I mean, there's a lot of factors. The difference between closing on the 5th of the month and the 30th of a month on a property could literally be a 4-figure difference in how much you have to pay at closing because of
Right.
prorated numbers that you're going to pay.
Right. Prorated taxes.
So yeah,
else.
and you got to pay all that. All that cost is it's the title costs, it's state and government recording fees, it's paying the seller back for taxes that they've already paid through the end of the year, putting enough money in an escrow account so that you have money to pay taxes when they're due coming up at the end of that period. Paying your first year of homeowners insurance, and then also having a buffer in there. All these escrow accounts, they're built with a buffer of a couple months worth of taxes and insurance, because we know that when you go to renew insurance and when you go to pay taxes again, more often than not, the number is going to be higher than it was the year previous. So that buffer is built in so that you don't have a giant shock in payment jumping up the next year to compensate for, now not having enough money and having to compensate for the future taxes going up. So there's also a lot of moving parts in that there.
HOA reserves, HOA fees. We have in certain counties in Oregon, we have like transfer taxes. It's usually a few $100s for a typical home. There's a lot of different things that go into that. And then of course the whole concept of, hey, if you're buying down rate and you want closing costs to be higher, so that your payment is lower, then so be it. And all of that. So it can easily oftentimes be, if you're aggressive and trying to get a lower rate, it can easily be $10,000 for a $500,000 purchase. I mean, it happens. 2%, sometimes 3%. There's also limits on that, which we could probably talk about some different scenarios where we've got a ton of concessions in the past and we literally spent every dime we possibly could. Because we had the money to play with. So there's a lot of different things, and it's based on the scenario of that loan.
But in terms of out of pocket, at least,
right,
earnest money is a refundable, in theory, deposit. So if you have like a financing fail or you can't come to terms, there's an appraisal issue and you can't come to terms on how you're going to solve that problem, you should be getting that money back. That earnest money then usually rolls in and becomes the down payment. When you go to closing, instead of them refunding you that money, they just have you bring the difference, between that and whatever is needed for closing costs and down payment. Usually that's 1% of the sale price. Would you say is like the most typical earnest money?
1 to 2% on the lower price points. It can be, more like 2%. Higher price points, it would be, typically 1%, $750,000 house, $7,500, no big deal. But, $200,000 home, $2,000 maybe isn't enough. So we'll bump it up to 4, different things like that. But it all goes towards the closing, your down payment, and so on. And there's different strategies there if you were trying to put together a deal that is more attractive than the next guy's if it's competitive.
And then you got inspection. What's the average inspection cost?
An inspection's going to be anywhere between $600 and $1,000 typically, on the higher end of expense. If you're dealing with, like, say, a on-site sewage system, like a septic system or a well versus city water, which you don't necessarily have to test. So there's different things like that can send you up or down on that sort of thing. The general rule of thumb is, even if it's $1,000, $1,200, whatever it is, that is very cheap insurance versus, hey, the well sucks for a million different reasons. We got to do a new well. Or we got to connect.
We're going to interview our favorite inspector, but we could go on. Radon testing is optional.
Exactly. It
blows my mind. Just Google radon. If you don't know what it is, it will blow your mind that it's even optional. I mean, it's surreal what it can do to people. And we've had horror stories about people who realized their house was effectively radioactive as they were selling, because someone actually took the time to do the testing. And now they've managed to negotiate the seller's going to pay for a radon mitigation, because that's not something that is expected to be a problem in the house. So,
which can be in the thousands.
It's worth it.
So it's worth mentioning at this point, this starts to become the point of no return for a lot of clients.
Yeah.
And the reason for that is because they have to pay for that appraisal, which can be between 600 and $1,000, depending on area and what type of home it is and all that.
Sometimes,
That sort of thing.
sometimes more. This is rare, but there are appraisals that we get back where it's $2,000 or even $3,000. And that's because of a house being potentially very remote or being very difficult to appraise. Appraisals are more expensive than they've ever been. There was a time when 300, 400 within my career, appraisals were well less than half of what they cost now. But they have gotten more complicated in certain ways. And appraisals are really easy. Like if I've got not really easy, it's a difficult job, don't get me wrong. But if I got a house and it's in a cul-de-sac of 120 houses that were all built, no, not a cul-de-sac, in a community, that'd be a big cul-de-sac.
Right.
A community that was built all at the same time and with the same specs, and there's just little variances in rooms and square footages.
Right.
That's easy. There's going to be recent sales in that neighborhood that the appraiser is going to be able to use and go, I just had to adjust the square footage by a little bit. But if you got like a geodesic dome in the middle of the forest, it's going to take a real expert to figure out what that house is worth.
Right.
And that's a unique problem. Those of you signing in here asking about geodesic domes, just call me up. We'll do a private.
Yeah, exactly. We'll do something about
that. For the most part, they're still probably they're getting close to $1,000. I think they'll be at $1,000, in the next 5 years or so.
But layer that on top of the $1,000 for an appraisal, and then layer that on top of an inspection.
Yep.
So you're a couple $1,000 in, and this is a house that you haven't necessarily guaranteed to buy at this point. So this is where we start having those conversations of, this is the risk of getting into contract of a home. You're not going to get reimbursed for this.
Yeah.
So you make sure, there's multiple points where we're going through the lending process, making sure that everything is dialed in there. You've given every chance possible for that underwriter to say, hold on, I want that document. I want this, that, whatever. That's why you want these things done at the front end. Also, you want to know, that's why we do the insurance up front. We want to know if this is a typical insurance policy or, oh, shoot, there's some flood insurance requirements or different things that cost 5 times the amount.
I've watched that surprise double the insurance cost just overnight because there's a little stream in the corner of the property.
Right. And it can easily happen. And granted, it happens less often with professionals like ourselves who've seen it 1,000 times, but there's still, we want to unearth those surprises. You're a couple $1,000s in between inspection and appraisal. So we're having, buying a home and going through the due diligence process.
You're lighting me up, man. I love it. It's not. If you can take one takeaway from this entire conversation, it is get everything done as early as you possibly can.
Right.
If you got a lender who does a pre-approval that's more advanced, where they actually run you through underwriting, that's fantastic. Right. That's getting some check marks out of the way. But either way, that stuff is great, and it's great from a marketing perspective, but it is non-promissory. There's a lot of boilerplate in there that says, hey, we're not actually qualifying you for a loan, though. At the end of the day, you still got to come back and do that because, hey, if you lost your job a week before closing, obviously we couldn't do the loan. So there's a lot of caveats in there to cover ass again. But, the big thing is that especially once you hit contract, you're going to go back to underwriting no matter what company you're at. Make sure that you get them everything and that it's accurate. And if you're in pre-qual and you've got a lender who's asking you for stuff, I've had people kick back on me hard. I've had to even argue with people about it because they feel like they're being investigated. Well, you're going to be borrowing 6 figures probably, in multiples here likely. So be ready for that, and don't feel offended when someone questions something. If there's a 1 in 100 chance that deposit is, not even 1 in 100, 1 in a million chance that deposit is money that you made by selling missiles to the Russians instead of, selling some gold bullion or your bicycle or whatever it is, then we have to investigate that. We have to get a bill of sale. We cannot. There's no part of the lending process where the federal government's like, well, if you're pretty sure you can assume whatever you want. That's not in the cards. We have to be assuming the worst, honestly, to a degree, because that's our job, is to find the worst. We need to find those red flags. We're tasked with that by the government. So, and by our companies. So, expect that and come into it with that idea of, I'm going to get everything really up front. Insurance is a great example. We've had insurance problems, potentially even crash and burn a transaction. And if the appraisal's already happened, that person, that appraiser is a contract employee. They have to be by design. There are no appraisers who work, for the lender. Otherwise, they'd be on my payroll. And I would say, I want everything to come out the way that I want it to, because I want to fund loans. It's in my best interest if I get the appraised value. We don't like under appraisal as a lender, which is why the government stepped in and said, cool, appraisers now have to work for a different company.
Right.
So the appraiser has to get paid. You can end up out your inspection and out your appraisal cost, and then find out that your loan won't go through if you don't really take the ball and run with it right at the beginning.
Right. Which is, again, I guess this is the third time around.
Yeah.
Get everything done up front, provide everything that's requested, and then some, and have that top-notch professional that is going to look out for your best interest, in the sense that they're also looking out for their best interest.
Yeah.
Nobody gets paid until we close, right?
Absolutely.
Nobody makes a living until we close.
And although we don't get paid, I don't get paid directly by my clients in theory. I don't, no one hands me a check for my services directly, but we do get compensated on the back end as these transactions close. There's money to be made, obviously, paying interest on a loan this size. So don't be afraid to call your lender. Don't be afraid to ask questions twice or three times. I would rather hear the same stupid question three times than watch a client make a stupid mistake. And I have unfortunately watched people make stupid mistakes. I've watched
Oh, I didn't want to bug you, Adrian.
$700 truck payment show up when we do that last credit check. Yes, we do recheck your credit right before closing. Yes, we call your employer. This is one of my favorite anecdotes. It's kind of a sad story, but I used to work at a lending company, and as we do right before closing, one of my coworkers, a loan officer, his back end team processor, calls up the company, and they go, "Hey, does Jeff still work there?" And they go, "No, Jeff's been let go." So the word gets back to the loan officer, and he calls the guy up. He's like, "Hey, Jeff, dude, what the hell, man? It's over. Like, why didn't you tell me you lost your job?" And he goes, "What do you mean?" And it turns out that HR had it logged that this guy was going to be let go, but the management hadn't actually had the conversation with him yet.
Oh, geez.
So the loan officer inadvertently told this guy he'd lost his job. And sure enough, yes, the transaction failed out, because you still got to be employed at least on the day of closing. If you get laid off the day after, that's your own business. No worries. Right. No worries. Yeah, no worries.
You're good. The ink is dry, right?
Dry. It's your house, for better or worse. But that's the thing. You gotta just keep on this ravenously. And especially if you are going to be one of these people who tries to save money, like I so stupidly did myself because I thought I was clever, and go with one of these fly-by-night internet companies that's probably run out of some guy's garage, and he's just brokering and just trying to get transactions in the door and has no resources. You're going to have to stay on top of them. I had to teach my loan officer the down payment program that I was trying to do. I had to explain to him that I did qualify for this program, and why, which is insane, but that person is licensed and out there doing business. Unfortunately, there's not like a secret shopper program going on where someone's making sure all the lenders actually know the rules. Sometimes they can think that they're qualifying you for something, send you up to underwriting, and get denied. It is super, super shitty, but it's a reality of our industry. And it's one of those things that shows the deep importance of working with professionals with experience, and ideally with a company that backs them, that's, got a positive reputation in the area.
Right. Yep. I love it. So the next episode in this series will be, we're going to dive deep into appraisals.
Yep. That's where we'll start back off, where the appraisal hits the desk and what it can mean.
And what happens when it doesn't work out the way we want it to, and how do we deal with it? And then we'll take you through to close.
Yep.
The last thing that I would mention here is just this concept of there's a bridge here between inspections and appraisal as the next step.
Yeah.
Generally speaking, we figure out whatever we're going to negotiate for results of inspections and conditions. That's not something that we don't want to send an inspection to a lender.
No.
These poor lenders,
or an insurance agent.
Yes, we've
had
had
that
that happen
argue
before
with you.
where
And your real estate agent should say, yeah, I guess we need to release it. Like you need to be backed in a corner to send that info. That's your data. You paid for it, keep it. Your inspection is yours.
And the concept there is just because and the reason why is because just because it shows up in an inspection, that an inspector who's licensed, bonded, and insured says there might be a problem with this and these other 50 items in the home. What happens is insurance companies and lenders would say, oh, well, you have to fix those 50 items, when really there was a problem with 2 things, and there was a watch list or a deferred maintenance list for the other 38 things, right?
Right.
And that's the piece that, there is mistakes made from time to time. Obviously not in a experienced brokerage team as well as a lending brokerage team. Those conversations will be had back and forth, and they'll work through that process. But
that's why you do the inspection nice and early too. I think it's worth mentioning too, because right now we're in a time where the lag time, because of the volume that's going through, appraisals are taking 2 to 3 weeks. Right. So we're ordering those right at the beginning of the transaction, because we want to we want to have that data really one, at least, if not 2 weeks before closing. We want to have all our data points in right in the middle of the transaction. We need to have all our data together. Right. So when appraisal turn times are faster, we actually wait to order the appraisal, typically like a week, because what we're really wanting is that the appraiser doesn't visit before the inspector visits and then returns their report. Because if the inspector says, hey, the roof's about to fall off, and the seller says, I don't give a crap, I'm not fixing that, there's no point in having the appraisal. It's time to get out of that transaction. It's not going to work. We know lending's going to kick back on that. So by doing things in order like that, but doing them quickly, you can avoid this extraneous cost of, well, I paid for an appraisal on a place that the inspection told me I already knew I wasn't going to buy it. So I needed to walk away. A waste of time, or sometimes we've seen it too, right? Where the inspector will call certain stuff out and they're simple fixes. So they do the simple fixes before the appraiser gets there. I'm talking like double strapping the water heater is a super common one, missing smoke detectors. An appraiser will literally park a transaction and wait for you to do that stuff and revisit to make sure it's been done. Right. If there is something like that is a code violation, you gotta, in our state at least, you gotta put straps on your water heater. It's dangerous. You'd have earthquake, it would fall over. And there's a number of little fiddly things like that good agents should catch before inspection as well. But at the end of the day, there's a lot of moving parts, and it is easy to miss something. So it's worth making sure that you do these things in order. Right. Awesome. Well, I love it. Hopefully we provided you guys some good information today. Appraisals will be next. I'm sure you guys are all salivating. Can't wait for us to dig into those. Just then getting to closing on the edge of your seat listening, right? Absolutely. We thank you so much for your time today, guys, and good luck out there. We'll catch you next time. All right. Thank you all. Bye-bye.